All right, everyone. I want to say welcome to everyone who's joining us for today's webinar, Real Estate 101, What is Passive Investing? Really excited to talk about this topic today because we get this question very often from new investors who aren't quite sure what passive investing is and how it's different from active real estate investing. So we're going to break down this topic today and really go deep into what is active investing, what is passive investing, how it can really benefit you, and how to get started as a passive investor as well. So, I've got lots of people on the call today. If you have any questions, as usual, I ask you to please put them in the Q&A box. We will get through as many of them as we can at the very end. And again, don't hesitate to ask questions. So there's no such thing as a dumb question or a stupid question, as some people say. We all start from zero. So if you've never been on our webinar before, if you're not quite sure and you're new to the Headway Capital platform, you're not quite sure what passive investing is, don't be afraid to ask a question. We are here to answer questions. Let's get started. If you want these slides, shoot us a text, 281-559-7061. Just send us a text, say, hey, I was on the webinar last night. Here's my email address. Please shoot me these slides. We'll gladly text these over to you. Just a quick disclaimer, this webinar is for educational purposes only. It should not be considered legal or accounting or investing advice. This information on this webinar does not represent an offer to sell any securities. We are just here educating you fine folks today. A little bit about Headway Capital. If you're your first time here, if you've never talked to me before, if you've never talked to Sid and Umar before, I want to say welcome to the Headway Capital platform. Headway Capital was designed and built to protect the wealth of busy professionals. So we are a private real estate firm, and our objective is to go out and find investment opportunities in the apartment space, or what's called the multifamily space, and provide those investment opportunities to you to give you back cash flow and equity appreciation, which ultimately gives you the freedom to do what matters most to you, and that is to be financially diversified in your investment portfolio and hopefully to help you eventually achieve financial freedom. Our team has extensive experience sourcing, betting, and investing in alternative investments throughout multiple market cycles. So we have been around. Our firm was founded in 2017, but Sid and Anam started investing in real estate actually right after the great financial crisis, back when all the real estate was really cheap and discounted because the recession had hit in 2008. They were able to build a pretty sizable single-family residential portfolio of around 34, 35 houses. Started passively investing, just like a lot of fine folks. I see a lot of our active investors here on this call, our active passive investors, I should say. They started passively investing for a few years before buying their first multifamily project, bringing in investors into that project in 2017. Sid was an oil and gas professional before he was in real estate, quit his job to go full-time in real estate, as mentioned in 2017. And Anam is a practicing full-time physician. She helps us a lot on the business development side because a lot of our great investing partners are physicians or doctors. They're practicing and they're very busy and they love the idea of diversifying in real estate, but they don't have the time. So they bring us as part of their investment portfolio team, and we bring alternative investments into the loop for them. And then last but not least is Umar Naqvi, who is our Chief Financial and Investment Officer. He's a guy who verifies all investments, makes sure they're great investment opportunities, but also he's ultimately the one who manages all of our books and accounting. So he does a great job of, not only is he operationally savvy, but he's financially savvy. He has his accounting degree as well. So just a great guy to be around if you like to talk numbers and operations. And last but not least, my name's Brian. Welcome again tonight. I'm the Director of Investor Relations. My job is to provide white glove service to all of our investing partners. So if you have not spoken to me and you are considering being an investing partner with us and joining us as a client and as a business partner, please reach out to me. I'll have a link here at the end of the webinar, but you can always shoot me an email directly, brian@headwaycapital.us, and I'll be happy to coordinate a call with you. My assistant will make sure that gets set up. A little bit about our core values, how we operate, how we do business, and what we stand for. We like talking about this because we think it's really important that all of our viewers and all of our investing partners understand what we are about over here at Headway. First is we are transparent. We're all about transparency. So it's the cornerstone that establishes investor confidence and long-term trust with our partners. So we have to be transparent if we're going to build a long-term relationship. We're not looking for one investment from all of our partners. We'd like to get multiple investments. We'd like to do multiple projects with you and provide you with multiple investment opportunities. In order to do that, we have to be have to offer transparency And then next, you'll see on this list is we have to do business with integrity. We got to be honest. We got to be ethical in sourcing and vetting these investment opportunities. We do a really, really, really good job. And one of our secret sauces, I think personally, is we run a really tight ship. We have lean operations at all of our properties and at our company. We want to make sure we're passing those savings on to our investors. We don't want to be hiring people we don't need, spending money on things we don't need. Our rule is if it doesn't produce ROI, a return on investment, for every dollar we put in, we don't want to do it. Of course, we have to hold ourselves accountable and take responsibility for our actions, whether it's good, bad, or ugly. We have to own it and make sure we're being transparent about it to all of our investors. I always tell people investments have risk involved, and not every investment goes perfectly. They're not all slam dunks as much as we wish we are, but we have to be accountable for anything that doesn't go well. Make sure we're letting our investors know why. And then we have to put investors first. Our mission is to meet your goals and your objectives first, of course, which is why you'll notice in all of our deals, our investors get paid first before we take a dollar out of everything. We do that through what we call the preferred return. So something that's really, really important to us. All this, when you summarize our core values and what we stand for, that provides what I like to call the headway difference. And you'll see a little bit about a few assets here that we own here in Houston, and a little bit about us. We have around 500 million of assets under management, almost 3,000 doors, and we target a 25 to 30% average annualized return. Could be 23, 24, could be a little higher, 31, 32, but we try to stay within that bandwidth of providing that mid high 20s on a base case scenario of an average annual return. And we do have over 400 active investors that have partnered with us. So we have a lot of great investors that have trusted us. A lot of our investors are repeat investors. So just another great thing that gives us a lot of confidence. Here you'll see some testimonials from some of our investors. These are all great investing partners. So if you're considering investing with us, we always like showing these to show you that we have the trust and experience of our investing partners, and we're always happy to provide referrals. We just love reading these things. Anytime we get an email like this from an investor, it just gives us the warm and fuzzies. There are some case studies here as well. You saw a couple of these photos in the previous slides. You'll see the type of projects that we work on. We like to find really good, really high quality investment opportunities. That might mean that they are newer assets, like you'll see here. Example A and example B are both newer assets. They were built in the late 2010, 2015, 2018 time period. But they're still in great locations here in Houston, and they are producing the type of returns that we expected them to produce based on the quality of the asset. And we also have some information here, a little bit about our NOI and how we like to improve performance and are really driving things at a strong basis. So again, if you want these slides, you want to dig a little bit more about us, reach out to me. I'm happy to share our track record, and you'll see it here, but I'm happy to share more detail as well. So you'll see here, since its inception, we've had 6 exits with an average annualized return of 48%, 2.3x multiple. And then these are all the properties currently in our portfolio. So let's get into the meat and potatoes. Why are you here? Enough talking about me and about Headway. Let's get started. What is passive investing? Real estate 101. A lot of people don't know what this is. So if you are watching this or you're live or you're watching a recording, we're going to break down what is passive investing. How can you get started investing passively in alternatives such as commercial real estate, such as multifamily real estate, which is our expertise and our bread and butter. So let's start by talking about what's the difference between the two. Did you know that there are different types of real estate investing? A lot of people actually don't know this. I know when I got started, I didn't know this. I didn't know there was a such thing as active investing and passive investing. I thought real estate investing meant buying a single family house and either flipping it or putting a tenant in it and keeping it. That's all I thought real estate investing was when I was really getting educated about it and getting into the industry in 2016, 2017. I didn't know this. So this is really valuable. So make sure you're paying attention to this. So active investing means acquiring projects or properties on your own. It's managing renovations on your own or with the general contractor. It's managing leasing or the manager on your own, right? So you're either hiring a property manager or you're doing it yourself. They or you help manage residents and including the maintenance. Even if you have a property manager, they're still going to call you and say, hey, Brian, we've got this $5,000 repair. Is it okay if I spend that money? So you're still going to have to deal with the manager and the maintenance, sort of CapEx requests. And you're limited by your time and your resources, right? When you're an active investor, you're limited by your time, which is the number one reason. I think the number one reason people decide to partner with us is they are short on time. They want real estate in their portfolio. They know how powerful a tool it can be, but they don't have the time to do it all on their own. So active investing requires a lot of time and attention. It can be a lot of time to find projects, negotiate with the realtors or the brokers, put the debt on it, deal with the refinancing, deal with the tenants, deal with the renovations. It's a lot of work, right? And you're limited also by your resources, which means most people are using their own personal capital or retirement savings to put down payments on things. Eventually, you're going to run out of money, right? So you can really stretch your dollar by partnering with others and buying bigger and better properties. This is a very common investing strategy for single family homes. So a lot of single family investors we talk to have a hard time transitioning their mindset. They're used to investing and buying houses and doing everything on their own. They like getting their hands dirty, so to speak. So this is sort of a epiphany moment for them, or a light bulb moment for them, to really think about not just being an active investor and dealing with all the headaches that come with being an active investor, especially if you're in the residential space, but switching your mindset to think about passive investing. So what is passive investing, right? So in passive investing compared to active, instead of going out and finding deals on your own, the sponsor you work with, such as us at Headway, we actually present deals to you. So we go out and find properties that you can invest in, right? So we usually have anywhere from 2 to 4 offerings a year. So I like to say once a quarter, we'll have something to present you, and you can either say, "Yeah, I love it, Brian. I want to invest," or you can say, "No, I'll just wait for the next one. This one's not for me." So those deals come to you. You don't have to worry about finding them on your own. The renovations are managed by us. We are the operating partner in these projects. So we are the ones who manage the renovations. We are vertical. We do have an in-house property management team. We also have an in-house construction team, and we also have a lot of experience in managing other teams, right? We've used third-party managers before. Some of our assets do use third-party managers, so we're very good at managing these people. We handle all the dirty work. You don't have to worry about it in the renovations. I already mentioned leasing and managers managed by us. We're the one who deals with all the leasing managers and the porters and the maintenance crew. All that stuff happens from us. And then this allows you to partner on larger deals and scale faster, right? So if you have, say, a couple 100,000 or 250,000 in your bank account, you can invest in 5 totally different projects and put $50,000 in each one. Or you could take that $250,000 and put it as a down payment on maybe 2 houses, right? Or 3 houses or 4 houses. But you can scale on larger deals, right? We're investing in deals that are typically in the 15 to $30 million range from a price standpoint. So there's a lot of value creation that happens that really helps grow your dollar very quickly, which we're going to talk about today. And this is a more common strategy for commercial real estate. The way you have to think about this and the mindset you sort of have to have when you open yourself up to passive investing is when you're driving in your car, and you probably do this on a daily basis. You're sitting in traffic or you're at a light, and there's a office building or apartment building or a shopping center you see, and you have to stop and ask yourself, who owns that, right? A lot of people think it's BlackRock or some big institutional insurance company, which is possible, but it also could be people like you and me, because groups come together like what we do, and we partner with investors to have them passively invest in these projects as a partner so that you can own a percentage of that piece of real estate as well. So it's really just opening up your mindset, having an epiphany change, and really understanding the power of passive investing. So let's continue to dive a little bit deeper in this. You have to ask yourself which one is right for you. Passive investing is not for everyone. Some people can't deal with somebody else managing the investment. They want to be dealing with the tenants. They want to be dealing with the toilets. They want to get the calls at 1 a.m. that somebody's, plumbing is leaking. They want to deal with, just vendor issues and landscaping and all the things that come along with managing these assets. If you're that type of person and you cannot give up control, passive investing is not for you. But if you're somebody who likes to find good projects, partner with good people, not worry about your investment, and only check on it once a month or so, this is a perfect vehicle for you. So you need to figure out which one is the right one for you. To be an active investor, you have to have liquidity to buy your own assets, right? You have to have the net worth to qualify for the loans. You have to be willing to take phone calls from tenants and the property manager, and you have to have the time to source investments, vet the investments, negotiate with the sellers, go through the closing process, and manage the investment while you still very, very likely probably work a W-2 day job, right? So it's very labor intensive versus being a passive investor. You have to, one, pick an asset class. Are you investing in multifamily apartments? Are you investing in retail? Are you investing in self-storage? You have to pick an asset class that you really like. We love multifamily. That's what we focus on. But it doesn't mean that it's the best thing for you necessarily, right? You have to find an asset class that you really love and stick with it. Then you have to define your goal, right, as a passive investor. Are you looking for cash flow? Are you looking for equity? Which one's more important to you, or do you want both, right? These projects can offer different types of benefits. Some have cash flow and equity. Some are more cash flow focused. Some are more equity focused, right? So really understanding what you're looking for. I would argue if you're closer to retirement, cash flow is probably really important to you because you are planning on retiring and you're not going to have that stable W-2 paycheck coming in. So maybe you're more focused on cash flow. It's really important to you. If you're younger, maybe you've had some success and you're in your 30s or your 40s or 50s and you're quite away from retirement, you have some time you have time on your side. So cash flow, while you might enjoy cash flow, equity is probably arguably more important because your goal is to let your equity snowball so that when you get to that retirement age, you can then start pulling cash out, right? So you have to really figure out what your goal is. There's no right or wrong. It is a case by case basis depending on a person. Third is to be a passive investor is you have to have the liquidity to invest. These are large investments. This is not like investing in a REIT or in a stock on the equities market. The minimum investment for most of the projects that you'll see, whether it's from us or if it's from another group that you interact with, is typically going to be 50,000, and that's even becoming more rare. We're starting to see 75 and 100K being more of a minimum. I will tell you, our average investor does write a check. I think average between that 400 plus investors, the average is right over $100,000. So of course we have some big check writers that write 250, 300 every time, and then we have some guys that like to write 50 or 75. So you do have to have some liquidity to get into these types of investments. And of course, it's really important for us when we get on those phone calls is we ask those types of questions because I don't want to take your last $50,000, your last $75,000. So this is for somebody who can absorb a loss if needed, right? So there are risks involved in these deals. And if for some reason we've never lost investor capital, we've never been in that situation today. But if for some reason there was a total loss and the $50,000 you invested is totally gone, you have to be able to absorb that without it being something that's detrimental to your life. So that's why it's important for us. We work with well-qualified investors. You have to find an operating partner like Headway, and there's a lot of great opportunities to work with us throughout the year. You have to be either sophisticated or accredited. So sophisticated means that you understand these types of investments. You've been educating yourself. You understand the relationship between a passive investor and us, the sponsor, and how we partner together. And it also means that you understand the risks involved with these types of investments as well. And you understand everything about the project that you're investing in. An accredited investor, per SEC compliance, is somebody who makes a certain income. They meet the sophisticated status. They of course understand the investment, but they also have an income threshold, and not everybody is accredited. So to be an accredited investor, you have to make at least $200,000 a year if you're single, $300,000 a year if you're married and file jointly, and you will have to have made that 2 out of the last 3 years, or not both. You have to have a $1 million net worth, not including your primary residence, right? So if you have 401k, an IRA, equities, any type of other retirement accounts, and it equals over, or cash, and it equals over $1 million, or other pieces of real estate that are not your home, you are an accredited investor and you're legally able to invest in these types of projects with less friction, so to speak. And then the last but not least, being a passive investor, is you have to learn to analyze deals. So really important you understand what you're investing in. So just kind of a typical structure. I like breaking this down for people because first-time passive investors can maybe be a little bit confused about how these types of investments work. So this is a typical structure you see of a passive investment, of a private investment, right? We call these private placement investments. You'll see an apartment complex, right? So that's sort of the entity that we're investing in. A new LLC will get created anytime we open up one of these investment offerings, right? So you'll see the investment property LLC, and there's two tranches of investors in these types that goes into these LLCs. One is going to be the operating partner. That would be an example would be us at Headway Capital. We're what's called the GP, or the general partner. We are the ones who find the investment, analyzes it, contributes capitals to close, right? So we put down the earnest money deposits, all the closing costs, stuff like that. We contribute expertise to the management, right? We are holding these projects for 3 to 5 years on average. So we're the ones who are the experts at managing throughout that 3 to 5 years. And then we receive a fee and equity at the sale. So typically when the deal closes, we make a small fee. It's called an acquisition fee, but we very commonly don't make anything in between, with the exception of an asset management fee, sometimes depending on the asset. And we make most of our money on the sale, right? That's really where we're incentivized. We're incentivized to do a really good job through those 3 to 5 years, so that when the property goes for sale, we are well compensated for that, right? Then the other class are passive investor partners, or the limited partners, or what are often called LPs. They're the ones who passively invest capital into the deal, right? So if you think about the general structure, let's just keep it simple. In real estate, most people know for a property like a single family home, most people try to put 20% as a down payment. We typically put more, especially right now in the lending environment. The markets don't allow you to put 20% down. The minimum you're very likely to see that they'll allow you to put down is probably 25%. Right now, it's between 25 and 35% we're commonly seeing in the industry. So for us, we have to bring that 25 or 30% to the table. We often have to bring some closing costs and some CapEx and some reserves. We always like making sure we have a lot of cash reserves just in case something happens at the property and we need to spend money on it, right? So an emergency, or if there's something that breaks, we need to have some liquidity to sort of weather a storm if something bad happens. So that capital is all raised from our investing partners, people like you on this call, as limited partners. And we also put money into the deal as well. We typically contribute anywhere from 5 to 10% of the total equity, just out of our personal pockets as well. So, but a majority of the capital comes of that 20 or 30%, the down payment comes from our investing partners, right? So it's really important you understand that. For that investment that you make, you get a few things. One, you get monthly cash flow. Right. So it could be monthly, it could be quarterly, just depends on the deal. A lot of our deals are actually quarterly, but there are some opportunities, if they're great opportunities that provide immediate cash flow and there's not a lot of renovations to do, they could be monthly, but quarterly is more commonly for us. You receive equity upside at the sale. So it's really important to understand that is not only are you receiving dividends every quarter or every month, depending on the projects, but when the property actually sells, there will be a split between you and us, the operating partner, right? Typically, our deals are structured either on a 70-30 or an 80-20 split. So what that means is 70% of the profits or 80% of the profits on a sale will go to you, the limited partner, the investing partner, and 20% or 30%, depending on the project, will go to us. So again, before that, there are different hurdles and stuff that can, when we're launching a deal, we make sure all this stuff's thoroughly explained the way money flows. But you receive equity at the sale. And the one thing that's not mentioned here, and we're not going to talk a lot about tonight, is there are some tax incentives, I should say, to investing in real estate through cost segregation and depreciation that allow you to essentially defer the taxes that you earn from your dividends and potentially defer the taxes that you owe from the sale and the profit split, the capital gains at the end of the deal as well. So typically the way this works is we'll create an LLC. There'll be a couple of share classes for one for the limited partners, one for the general partners, and then you will invest and you will own a share of that LLC. And that LLC protects everybody from any types of risk or liability if something were to happen at the property. So pretty standard, pretty easy model. The benefits. So let's talk about the benefits of being a passive investor. I get this question all the time. Some people, think that they should be an active investor and should do what we do, which is totally possible, right? Of course, you could be the next Headway, or you can start a company and be a competitor, but it's a ton of work, and there are a lot of hurdles that you have to overcome in order to get in this position to qualify to buy these types of properties, to get to know the brokers. So I always like encouraging people that if you plan on being an operator, if one day you're telling yourself, and you're on this webinar and you're telling yourself, I want to be in that seat. I want to be the operator. I want to be the partner. I want to be the person putting all these deals together and managing the property manager. The best way to get there is to start off as a passive investor. I started off as a passive investor. Our CEOs, Sid and Anam, they started off as passive investors first, because being a passive investor allows you to understand how these projects worked, how they're structured, and what a good deal looks like, right? So there's lots of benefits. That's actually not mentioned on here, but it's something to keep in mind. So one of the first things I want to mention about the benefits of being a passive investor is the hands-off investment approach, right? So there's no dealing with tenants, no dealing with toilets. Once you make your investment, all you have to do is review monthly reporting, and that's it. So I mentioned earlier that we're really big on transparency and reporting. We provide updates to all of our investing partners once a month via email or through our investor portal. And all you got to do is look at that. What's going on at the property? How are the operations? How's the marketing? What's the cash flow looking like? What are the financials looking like? Is it going good, or is it still in stabilization, meaning it's still being worked on and still being renovated, so there's not quite any cash flow or distributions yet? Or is it stabilized, meaning the renovations have been done and now it's time to pay distributions because the property's cash flowing much better? Or are there some opportunities where there's some struggles going on where things are a little bit delayed on construction? COVID caused a lot of delay for materials. So, there were some projects we have several years ago that were later on distributions just because of material shortage. We couldn't renovate units. So all that comes into a monthly investor packet that you get to read every month. And of course, if you have questions, you can schedule a call, or you can fire back an email and say, hey, I have a question about this thing you put in the update. Can you answer this, please? Absolutely. We try to reply to all of our investors within 24 hours. That's sort of my golden rule for myself. I know when I invest in projects, I want to be replied to as quickly as I can. So all you have to do is read those reports and ask a question if you see it, and that's it. You're done. You get your quarterly distributions. You'll get a notification when your distribution hits. And when the property's getting ready to sell, we notify everybody in 3 to 5 years, and that's about it. You rinse and repeat with new projects, right? The potential for steady cash flow and dividends. I think this is arguably one of the top benefits of being a passive investor. Is projects can produce regular dividends paid to investors, right? So there's different types of projects, of course, when it comes to real estate. Some projects actually don't pay dividends. It's all equity on the upside. We don't typically do those projects, but there are groups that do, right? So I'll give you an example. New construction real estate, new construction. If I were to build an apartment complex, that can take 18 to 24 months. If you were to invest in a property, you won't get any distributions for 18 to 24 months. Why? Well, the building's not built yet. It's not open. They can't lease it. It's not occupied. And even once it's built and it's open, it takes anywhere from 6 to 12 months or more to stabilize it. And stabilization is bringing it to 90% occupancy. So what that means is it could actually take 3 years before there's any actual profits at the property. And then what happens at the end of year 3? The property gets sold, because after builders build stuff, builders very rarely hold stuff. They build it and they sell it and they move on to the next one. They build it, they sell it, they move on to the next one. So if you love those types of investments, which I know lots of people that love that stuff, there's no cash flow distributions, but you get a big equity pop at the end. You invest 100K today, 3 years from now, I give you 200, 220, 250K, but you get nothing along the way. Some people like that, right? Our type of projects, we typically start paying distributions and dividends somewhere between 6 to 12 months. That's usually our goal. We need some time to stabilize the properties because we're buying properties that need a little loving, to be frank, whether it's operationally or cosmetically. But we will always notify you when you're making an investment. Our forecasts, again, it's always a forecast, nothing's guaranteed, right? Is that we want to start paying distributions within 6 months. 6 to 12 months is always our bandwidth. Diversification of investment portfolio. This is a massive benefit of being a passive investor, because when you're investing in all your money into one project, or you're investing in one single area, you don't get to diversify as much, right? So passive investing gives you the opportunity to invest in multiple places and multiple asset classes. So not only can you invest in Northwest Houston, Southwest Houston, Dallas, San Antonio, you can also invest in different asset classes. And if you're not sure what I mean by that, is there are different types of properties. We typically call them like A, B, C quality. So an A-class property is something that's newer. It's probably in a nicer area, has higher average medium income. The people are more affluent. The rents are higher. So that's an A-class property, something you and I would probably be very excited to live in, right? A B-class property is more of a workforce housing play that's a mix of quality and value. So it's not the most expensive apartment, but it's not workforce housing in a C-class community, which is the next tier. And those two tiers are the ones that we typically play in. So we love B-class assets. Those are typically going to be your 1980s to 2000s vintage, good sized properties in good areas in good school districts. Anything below 1980, depending on where it's located, it's typically what's called a C-class property or workforce housing. So when you invest into syndications, which is what we're talking about here, being a passive investor, you get the opportunity to invest in different type of projects in different areas and different types, right? So for example, Headway might offer you an opportunity this quarter to invest into a C-class property, which you like. C-class properties have more upside because there's more risk involved with renovating the units. So there's more upside. But next quarter, I might present you with an A-class property, and that's less risky because there's less renovations, but there's also less upside because there's less risk, meaning you won't have a strong cash flow and you won't have a strong equity upside, right? You can invest in both. That way you have some diversification in your portfolio. You don't have to invest all in C-class. You don't have to invest in all B-class. You don't have to invest in all A-class. You can say, I want some C's and I want some B's, or I want some C's and I want some A's, or I want all B's. It's really up to you. And the last thing, we're not going to talk too much about taxes. I'm not a qualified CPA, so I don't want to go down that rabbit hole. Is there are tax advantages or benefits to being a passive investor. And one of the things that I know I talk a lot about when I talk to investors that have a very high income is they're always concerned about taxes because they're in a high tax bracket. So if you're somebody who's in a high tax bracket and you're getting income from multifamily or from real estate by partnering with us, you probably have a question about how is this taxed? Well, everybody's situation is different, and you should always consult your CPA or financial advisor before investing. So let me start with that disclaimer. But commonly, what we see is that the depreciation that we are able to share with all of our investors from doing what's called a cost segregation study, which essentially is a study that breaks down the value of everything on a property over a 27.5 year depreciation schedule and forces all that depreciation through what's called accelerated depreciation, bonus depreciation into the first few years of the property. So instead of waiting 27.5 years to recapture that depreciation, which can be used on your taxes as losses, we force it all within the first few years, right? So you get a really heavy depreciation schedule those 3 to 5 years you're investing with us. Well, what that means is that the dividends you're getting are often tax deferred, meaning let's say you get an 8% return year one for investing with us. Well, if you invest $100,000, that's $8,000 for the year, right? You get $8,000 as dividends. Well, that $8,000, it's going to show as a loss on your K1, which actually means that you will not pay taxes on it today. Now, I'm not going to say it's tax free, it's tax deferred, right? So you're using depreciation to offset your passive income, and you can only use that if you're a W-2 employee. You can only use passive depreciation to offset passive income. You can't use passive depreciation to offset your W-2 income unless you're a qualified real estate professional, which I'm not going to go down that rabbit hole. So there's a lot of tax benefits for investing in real estate. It is situation by situation, but just know if you're looking to passively invest in real estate, I am happy to connect you with one of our preferred CPA partners that can help you better understand your situation if you're looking to invest. Let's talk about the types of passive investing. So we've been talking about the benefits. We talked about what is passive investing. I think it's important everybody understands that there are different asset classes and they all bring different risks and rewards when it comes to passive investing. I'm going to start with the favorite one of mine, and I'm biased, obviously, is multifamily real estate. So multifamily is another word for apartments, right? So if you hear me say multifamily, I'm talking about apartments. What risks are associated with apartments? First of all, there are risks with economic downturn, which could obviously impact the residents, right? So if there's a massive recession and people are getting laid off, it could be hard for them to pay their rent. It's very competitive, right? There's a lot of apartments that have been built, not only in Houston, but all across the United States. So it's important you offer great customer service and a really great place to live. And then there are property management challenges, right? So you're constantly dealing with property managers, you're dealing with tenants, you're dealing with toilets, you're dealing with the management of the staff. There are some operational headaches that come along with multifamily, and this is why we always recommend investors just become a passive investor because you don't have to deal with it. But there are challenges that come with it, right? But there are also big rewards. The rewards for investing in multifamily, obviously, the potential for stable cash flow. Residents, they sign 12-month leases. That means they're paying their rent every month, ideally, right? So that stable cash flow is something that's nice to predict. There's economies of scale. The bigger the property, I would argue, the easier it can be to operate, right? So when you're buying a 20 unit property, it's very hard to operate that because there's no manager on site. There's no maintenance person on site. There's no leasing office. Well, if you buy a 200 unit property, you've got a property manager, you've got a leasing assistant, you've got an assistant manager, you've got a porter. All they do is pick up trash all day. You've got 2 or 3 maintenance guys that are repairing stuff and fixing stuff. You've got your make ready guys that are turning units and cleaning, housekeepers. You got a full staff. You're managing a business, right? So there's economies of scale with the larger assets. Of course, you get appreciation. Properties typically go up in value as long as they're being operated well. Now, the way these properties are valued is based on NOI divided by the cap rate. So as long as you are improving the NOI, we can't control the cap rate. That's basically like it has to do with the market, very similar to what you would call like comps in the single family space. But the cap rate is kind of set, right? So Houston market on a B class asset right now is probably about a 6 cap, 5.75, maybe a 6 cap, maybe low 6s, right? So as long as we know that that number down there is not changing very, very rapidly, and it's not common that it does, COVID really changed a lot of things and kind of rocked the world, but what's going on is not very common. The cap rates are usually pretty steady. They don't move very volatile. They're not super volatile. They have been the last couple of years, but that's not common. As long as you're improving the NOI, you're getting a lot of appreciation. The value of the property is going up. And then last but not least is you're getting good demand and depreciation. So people need to invest in people need apartments now more than ever. The cost of housing in America is insane, to be quite honest. I have seen some crazy statistics that, the average person, I think today, as of March 2024 was the last time I saw a data point, the average mortgage, including principal, interest, taxes, and insurance in the United States right now is $3,000 a month, right? So that's an insane amount of money. The average apartment in a place like Houston, for example, for like a 2 bedroom is like $1,500, $1,700, right? So there's a massive delta between renting and buying, and that's going to continue to push demand, in my opinion. There's other asset classes that I don't want to be biased to multifamily. We've got car washes, right? So car washes are a really attractive asset class that we've offered our investors in the past. It's not something we do very often. We're very selective and have to find good deals before we offer car washes, but there's obviously risk involved with them as well. There's weather that can impact the operations of a car wash, right? So if it's raining, that brings down sales. If it's snowing in certain markets, that brings down sales, or it can cause closures. You have equipment and maintenance costs. These machines are very expensive to maintain, so that's something that is a risk. Something breaks, car wash goes down. Now you're not making any money. There's of course insane competition. Car washes are popping up all over the place. There's probably 4 in my neighborhood alone that I know within a 5 or 10 minute radius. So you have to be very careful about investing into the right sites. And then there's seasonality. Car washes, depending on the market, there's seasonality to them, right? If you live in a place like Texas, you can probably wash your car all year because it doesn't snow here a lot, and we do have some rainy seasons, but it's not that bad. But then you have markets that are more colder weather markets, and there's seasonality there, right? If it's really cold in January, February, March, it doesn't really warm up till April. You might have some down months. So that means if you're getting quarterly dividends, maybe there's some months where you actually don't get a dividend in January, February, March, but then you get a really high dividend in the summer when sales just explode, right? So it's kind of ends up washing itself out, but there's some potential volatility there. It's due to seasonality. Rewards, great for cash flow. The subscription model does bring consistent income. So as long as you're getting people to subscribe to the car wash by signing up for the monthly packages, it does offer stable cash flow. And there's depreciation on the building and equipment, very similar to multifamily. An asset class we don't really touch, but I wanted to throw it on here so that people understand that we're unbiased, just trying to educate here, is a flex industrial space. So a flex industrial space are those buildings you drive by when you're on the highway. Sometimes they're big, sometimes they're medium, 200, 300,000 square feet. And they're places for people to kind of divide up the space and offer small manufacturing places. So they're flex spaces in the sense that they're not only manufacturing and distribution and warehouses, but they actually offer office space as well. They're typically divided in various ways. It could be 70-30, 80-20, 60-40, where 20 or 30% of it is office. The rest is warehouse or manufacturing or distribution. There's lots of risks in these, including dependence on the economy. These are businesses that occupy the space. If the economy gets hit really hard, it's possible those businesses get impacted and they aren't able to pay their rent. There are longer tenant turnover times, which means if somebody moves out of a space and now you have 25,000 square feet vacant, it on average takes 9 to 12 months to fill a spot like that. That's going to impact your cash flow, right? Long periods of vacancy, again, just something to keep in mind. There are great rewards to it, and I actually love this asset class. I have invested in it before. It's got steady income because if you do have good tenants in it and it's in a great market where there's not a lot of weather impact, you do have steady income because the tenants are businesses and they want to pay their rent. They don't want to get their door locked. They need to sell stuff. They need to manufacture stuff. They need to distribute stuff. Triple net leases are another great benefit of retail. I'm sorry, flex industrial. And that's because these spaces often commonly charge triple net and CAM expenses, which basically means all the expenses of maintaining the property get passed on to the tenants, which is just phenomenal. There's growing demand since COVID. Everybody knows how popular online shopping has become. So these spaces are being built everywhere. And there's limited supply of small to medium spaces. So there's less and less of this around around my city, at least in Houston. They're building these massive 1,000,000 square feet buildings, but nobody's building at 200, 300,000 square feet. So there's high demand for that smaller space, which means it's a great place to potentially invest. Last but not least, different types of passive investments. Private lending or hard money lending. We actually have a fund for this called our Headway Capital Income Fund. And it's essentially where we give out hard money loans to people, very short loans. We charge them a certain interest rate, usually around 13.5% to 14%. And then there's an arbitrage where we actually pay our investors 8%, right? So they invest, the person who borrows pays 13. We pay 8 and there's an arbitrage there, right? So there's some fees and stuff, of course, involved, and we want to make a couple points of it as well as the operating partner of the fund. But this is a great way for us to keep capital moving. And it's also, I'm not here to pitch the deal, but it's also an opportunity to be liquid. This fund is actually liquid, so you can invest into it $100,000. And if you need your money back, you send me an email, you fill out a quick form, and we promise to return that capital within 90 days or less. Usually it does not take 90 days unless you have several $1 million in there. Usually it's more of a 45 to 60 day time window. So it gets back to you as quickly as we can. But there are some risks involved with giving out hard money loans. Of course, you have loans that can default, which can lead to a foreclosure on the borrower. And there's also no upside or no tax benefits. This is more of a cash flow play because we are just essentially playing lender. We're giving out loans. We don't get the upside on the sale. We're just getting that interest rate, that 13% that we talked about. And because it's just normal income and there's no depreciation, there's no tax benefits. This is just ordinary income. But there are great rewards to this. One, it does offer stable cash flow. This private lending fund that we actually offer does pay monthly dividends, and it pays 8% for any investment over $100,000. It does have a 9 and a 10% bracket, but it does get a higher investment amount. I believe it's 500K and $1 million. And there are slightly longer lock periods for the $1 million 10%. But 8% is anything above 100,000, between 100 and 250,000, I believe. And it has that 90-day liquidity, which is great. It does offer compound interest. So if you're somebody who doesn't want the cash flow, you don't need that $8,000 a year for that $100,000 investment. You can actually just leave it in and it'll compound over time, which is just amazing. And I already talked about the liquidity. So these are different types of passive investing. Hopefully that gets you to think about, when you're thinking about passive investing, there's so many options out there, and it really comes down to educating yourself, right? So how do you start your investing journey? There's lots of different ways to invest. One, you can use cash, right? So if you have money in your bank account, call me, as I like to say, right? Because we could talk about the different options we have for you. That's always an option. Second option, a lot of people don't know about, is self-directed IRAs. If you have a 401k or an IRA and it's sitting and it's not being used, you actually can roll it over to what's called a self-directed option, self-directed IRA or solo 401k. And that actually gives you the ability to use that cash in your 401k or in your IRA to invest in these types of private alternative investments. Very powerful investment tool. You do need to do it. There's a lot of legal compliance. Don't worry about that. Don't get scared or nervous by that. This is all actually done by a third party. We have some great partners. They're called custodians that help you manage the self-directed IRA, the self-directed 401k process. But I talked to a guy the other day that had several millions of dollars that he rolled over to a self-directed IRA, and now he's retired, and now he is looking to deploy this capital into real estate investments because he wants to diversify his portfolio. So again, just another really powerful tool a lot of people don't know about. So if you have questions or interest in opening up a self-directed IRA or transitioning one of your accounts into a self-directed status, you need to speak to a custodian, somebody who's an IRA expert. Please reach out to me. I'll be happy to connect you with that person. So getting started, if you have cash, if you have a self-directed IRA or 401k, how do you get started passively investing? So one, and I've been mentioning this the whole time, and this is why we host these webinars, is you need to ask yourself two questions. One, do I understand what I'm getting into? So education and research are so vital. We never want to take anybody's investment capital that doesn't understand what they're getting into, right? This is 50,000, 100,000, 250,000 for a lot of people. If you don't understand what you're investing in, that's not a good thing. So you need to make sure you're doing education and research, show up to these webinars, read the emails we put out, watch YouTube videos, listen to a podcast about real estate investing. Make sure you're as an expert as you can when it comes down to the subject matter. And then first, you need to ask yourself too, is this for me, right? You need to do a financial assessment or financial analysis and say, hey, is this right for me? Is this something that I actually think can be a viable tool in my investment portfolio? If the answer is yes, you speak to your significant other and they agree, real estate's the way to go. I want to put 20% of my portfolio in real estate, 30% of my portfolio in real estate, whatever the number you find out is for you. Of course, we're not ever preaching here, sell all your stocks, come to real estate. That's not what we're preaching here, but is diversifying into real estate an option for you? You need to have that hard question, ask yourself that hard question, and then just talk to your significant other around it. You need to find a private sponsor like Headway, right? So there are various sponsorship groups and organizations like Headway. We're called operators or sponsors or general partners. tomato, tomato, same thing. You need to find a group like us, and you need to complete an application to invest. Once you complete that application to invest, you're going to be required to schedule a discovery and qualification call. It doesn't matter if you're doing it with us or you're doing it with one of our competitors or somebody else in the space. They're always going to want to speak to you. And that has to do with everybody wants to make sure that you understand what you're getting into, you understand the risks, and you're qualified to invest. You understand what you're getting into, right? So you want to schedule that call. As soon as you submit your form, it's going to offer you the option. And you want to get on this call, and they're going to ask you a bunch of questions, not tough questions, just to make sure you understand. But you also want to make sure you ask good questions too. One of the things we always are proud to share is our track record, right? So after you get off that call or during that call, ask about their track record. How many deals have they done? How many deals have they closed? Have they ever lost investor capital? There's a lot of smart questions you want to make sure you're asking. And they should be able to provide you with some literature, some material to show you what they've done in the past. And last but not least is if you are approved to invest and they say, hey, I feel like this is a great opportunity. I feel like we'd be great partners. We're going to put you on our private investor list. You're going to now see access to all of our opportunities. You want to move quickly when something opens up. So when something opens up to invest, these deals can get filled very quickly. Depending on the size of the group, there are often thousands of people on the investor list. I will tell you that we at Headway have right around 5,000 people on our investor list, right? So that's why they get filled quickly. So if we are looking for 50 investors or 100 investors, and we have 5,000 on the list that we've built relationships with, it's going to fill it pretty quickly, right? So when these deals open up, we recommend you review the email quickly, sign up for the webinar and watch the webinar that we have. That's usually about 45 minutes to an hour breaking down the investment. And then you usually will get the option to submit a commitment form to say, hey, I'm interested in this deal. Please save my spot. You want to make sure you sign that commitment form, and it takes 10 seconds. Go on there, first name, last name, how much are you planning on investing? And then you hit the submit button. Your spot's been reserved, right? And of course, if you don't like what you see, once you start reading the legal docs or doing due diligence, or the more you think about it, you realize this isn't the best fit for you. Of course, you can always back out. It is a soft commitment, but you want to make sure you reserve your spot and soft commit. Otherwise, if it gets full, you're going to go on what's called a waiting list, and you might not have access to the opportunity. So moving quickly is really, really important. So just kind of final statement, we're summarizing today. We're getting to about the 45-minute mark. I want to open it up for Q&A for sure. Is passive investing 101, right? So what is passive investing? So today we broke down what is passive investing, what's the difference between active and passive investing, and you need to now decide after hearing all this, which is the best fit for you. If you're trying to be an active investor and you've never invested in real estate before, or you're new to the commercial real estate space and you're a single family residential real estate investor, I highly recommend you start off in passive investing. That is going to give you the best education possible, because reading, watching webinars, listening to podcasts, going to conferences, that's all theory, right? It's all theory. The way that you're going to really learn, it's just like anything else in life, and that's by doing it, becoming a passive investor. And then after a few months, well, not months, probably a few years, a year, 2 years, then you can start becoming an active investor. You can say, hey, I want to go out and buy my own projects. I don't want to be passive anymore. And you can go down that journey, and we can actually help you. We do provide some consulting for people that are interested in being an active investors. So you can always reach out to us and say, hey, Brian, I've been a passive investor. How can I get started on the active side? And we're always happy to also help people that have partnered with us. If you've been a passive investor in one of our clients and you're interested in becoming an active investor and getting into the space on our side of the business, we're happy to guide you along the way. We do provide some consulting there, right? So just something to keep in mind. And if you're just here to learn about passive investing, hopefully this gave you a better summary of what is passive investing, how it can benefit you, and the power behind being a passive investor. So if you want to join our investor list and become a passive investor, there is a process. We just talked about it. We do need to schedule a call. Go ahead and fill out the form I'm going to show you here in a second. You do have to get qualified. We'll ask some questions for you. And once you're accepted, we'll present all opportunities for you to review, which is step 4. You'll qualify yourself for these investments to make sure it's a good fit for you. And then you will get a welcome kit if you decide to invest, and it'll be in your portfolio. And usually once we close, we start paying distributions, like I said, within 6 to 12 months. So if you want to join this private investor club and get access to these investment offerings, you're going to need to scan this QR code. And once you join this private investor club, you're going to get access to a few things. One, you're going to have access to our track record. 2, you're going to get invited to private events we have only for people that are a private investor club. These are property tours. These are dinners. These are lunch and learns, things that we do to really add value to the community. So it's really important that you sign up for this by scanning the QR code or reaching out to us. And you can actually go to our website. If you go to Headway Capital headwayinvestment.com, excuse me, you can see the link on the top right-hand corner. It says invest now or invest. You're going to click that link. It's going to take you to a form. That's the form you're going to fill out. It's the exact same form for this QR code. If you want these slides or if you have any questions, feel free to shoot us a text, 281-559-7061. So now I want to say thank you to everyone, and I want to open it up for Q&A. So if you have any questions, please feel free to drop them in the Q&A box right now. Let me see. Let me check the box. Okay. All right. So we got a couple coming in. Let's see. How does passive investing in real estate compare to the stock market investing? Oh, good question. It's different, right? So passive investing in real estate is not like investing in stocks in the sense that if you're somebody who likes to sort of day trade or manage your own portfolio, you can go on like E-Trade or any of these other platforms, right? And you can sort of pick stocks and buy and sell and trade and buy options and all that stuff, right? This is very different, right? And those are short term because if you buy a stock and you want to sell it, where you just press a couple buttons and boom, you're in and out, right? These are long-term investments. These are on a minimum 3 years, and on a maximum, they could go five. They could go seven. Some groups do 10-year projects. We don't do 10-year projects, but there are some groups that do that, right? So it's very different in the sense that once you're in, it is almost impossible to get out. I'm not going to say it's impossible, but it's really challenging. You would have to sell your shares of your LLC that you are invested into in order to get out. So compared to stock market investing, it's definitely illiquid compared to some sort of a liquid thing. But I will say the one thing that I do love about it is that there's more of an intimate relationship, right? When you're investing in a stock or on the equities, or if you're investing in a REIT, which is very similar in my opinion, you don't get that one-on-one attention. You don't get to talk to the sponsor. You don't get to see the property. We invite all of our investors out to actually come see the property, right? So that you don't get that first sort of access and that exclusivity and that warm, relationship, that one-on-one treatment. So I think that's a big part that's different than investing in the stock market. So what are the minimum investments required for participating in real estate projects like this? Mentioned that already, typically $50,000. Let's see what we got here. I already answered that. Exit strategies. So what should I consider in terms of exit strategies? Good question. So if you're a passive investor, and an exit strategy is essentially reviewing what the plan is to sell the property. What you should consider when reviewing the plan to sell is one is how long is the hold? Is it 3 years? Is it 5 years? Two, what are they planning on selling it at? We like to talk in cost per door when it comes to investing. So you'll hear us talk very commonly about this property's 50K a door, 100K a door, 150K a door, whatever the project is. Since we talk about that, if you're buying something at $100,000 a door, which is $100,000 per apartment unit, and you're planning on selling it at $200,000 a door, that's super aggressive, right? You're doubling the price of the property. Highly unlikely, right? So you want to look at that and make sure it's conservative is a hard word to use, but reasonable, right? So if you're buying at $100,000 unit, and you're planning on selling it at $140,000 unit, or $130,000 unit, a 30 or 40% growth, that's more realistic, right? But to see it go from $100,000 a unit to $200,000 a unit, that's highly unlikely depending on the situation. It is possible, but you want to make sure you ask questions about that. The second thing on the exit strategy you want to ask is what is the cap rate on the exit, right? And we didn't talk a lot about and getting technical today, and we're talking about cap rates. I did mention earlier that these properties are valued based on NOI and the market cap rate. So when we're buying a property, we have what's called an entry cap or a going in cap or purchase cap. That's essentially what are we paying when we enter. And that number isn't as important because if you're in buying a property that has a value add play to it, the NOI might not be where it needs to be. So essentially the cap rate might actually be lower than we hope it would be at, right? So what's really important is what the market cap is and then what the exit cap is, right? So if the market cap for a value add C-class property is a 6 cap and you're planning on selling it, you want to always plan to sell it at a higher cap rate for the sake of conservatism. Now, would it be great if the property sold at a lower cap rate? Yes, because the lower the cap rate, the better the sales price is, right? So if you're buying it at a 6 cap and you sell it at a 5 cap, you're going to make a lot of money because you're selling it for a lower cap rate, right? 1 divided by 5 is a much larger number than 1 divided by 6, right? So that's the easiest way to think about it. The top number is your NOI, the bottom number is your cap rate. So 1 divided by 5 is a bigger number than 1 divided by 6. So if you buy at a 6 and you sell at a 5, you're going to there's that spread, you're going to make a lot of money. But if you buy it at 6 and you sell it at 6.5, it doesn't mean you lose money because the property still might be very profitable depending on what you bought the property at and the business plan. But for the sake of conservatism, we always actually plan to sell it at a higher cap rate. And if the numbers work and the investment looks really solid at a higher cap rate, that gives us a lot of security that if cap rates do expand and actually go up over the 3 to 5 years that we hold the property, we're still going to be in a very good position, right? What we typically do is if we're buying at a 6 cap, we'll plan to sell at a 6.5 cap. We add 10 basis points per year. So 5 years would be 50 basis points. So from 6 to 6.5. What we don't do is plan to go down. So we don't buy at a 6 cap and plan to sell at a 5.5 cap. We would think that that could be potentially arguably risky. So the exit cap is something you really want to make sure you ask a question about. How does Headway Capital select its real estate projects? Oh, good question. So we buy, well, first of all, it's got to be multifamily 90% of the time. We like apartments. That's our specialty. We stay in our lane, right? So it's got to be multifamily. We like Texas. We like landlord-friendly states. So we really focus on buying deals in Houston first, Dallas and San Antonio. So it's got to meet location qualifications. It's got to be in a good neighborhood or a good area that we feel like is a safe, great neighborhood where people are going to enjoy living. So location is really important. And if it is in a rougher part of town, we got to make sure we're buying it for a substantially discounted price. But we typically don't look at deals like that. Some groups do. Some groups love to buy in rougher markets because they can buy things really cheap. That's not us. So location is really important. For us, we got to see meat on the bone. So what that means is when we're looking at a deal, it's got to have upside. It's got to have some sort of renovation upside, meaning we can renovate the units and improve the rents. It's got to have operational upside, meaning it's not being operated properly and there's some juice to squeeze out of that lemon. Or it's got to have some sort of financial upside, meaning maybe the property isn't collecting enough income, its expenses are being mismanaged, or it has the wrong debt product on it and they're paying too much to the lender. They have the wrong loan on it. So there's financial upside by buying it and putting a better loan on it, right? So we want to find those types of opportunities that are unique. They are hard to find. Where we look at, man, for every 100 deals or 100 investment opportunities that we see, we probably get interested in 1 or 2. It's a very, very low number. So we look at hundreds and hundreds of deals a year before we select one to present to our investors and actually chase. So that's kind of the base criteria. As far as an investment returns, we talked about that at the very beginning of the slide deck. We're looking for typically a 7% cash on cash return. We're looking for a high teen IRR, typically around 18% IRR. We are looking for a 20 to 25% average annualized return. And then we want to double our investors' money. So we're looking for what's called an equity multiple. We're looking for a 2x multiple. So kind of keep it simple. If you put $100,000 in, we want to give you back 200 in 5 years. 2x multiple, right? That would be a 20% average annualized return if that was the case, right? So that's how we select our investment. So if it's a great property, good location, good size, good area, good bones, we want to buy stuff that's 1980s and up vintage typically, and it meets those financial metrics. Those are sort of like the layer one. There's a lot more due diligence that we do beyond that, but that's sort of like, okay, do we want to spend time actually looking at this before we go spend a lot of time and a lot of money actually deciding if it's a good investment, right? So those are our criteria for finding deals. So we're at the hour mark. So I'm gonna wrap up questions. If I didn't get to your questions, please reach out to me directly, investor@headwaycapital.us, or you can reach me at brian@headwaycapital.us. I want to say thank you to everyone for attending today's webinar. Hopefully you learned something about what is passive investing compared to active investing. If you want to join our investor list, again, I'm going to tell you one more time, please scan this QR code to join our private investor list or go to our website, headwayinvestment.com, sign up. We've got some exciting investment opportunities coming in the future. We're working on lots of great projects that I think are going to be a great fit for those looking for cash flow and equity upside, and they like investing in Texas. So I encourage you to sign up for our investor list. I encourage you to keep attending these webinars and get educated so that when the next investment opportunity comes available, we can have a great conversation about it. But thank you for attending. I look forward to seeing you on the next one. Have a great day.